Good morning, everyone. My name is Nabilah Abdul Shukur. Today, I will be presenting my study titled Financial Inclusion and Bank Efficiency Evidence from ASEAN 6 Banking Sectors. This research explores the nuanced relationship between financial inclusion and banking efficiency using empirical data from 6 ASEAN countries. The banking sector is a critical pillar of financial system, accounting for over 70% of total financial assets in many emerging markets. It plays a vital role in financial intermediations, resource allocations, liquidity provisions, and payment services, all of which are fundamental to economic growth. Balancing regulatory requirements such as capital buffer with growth is also crucial. Banks additionally support monetary transmission mechanisms and the financing needs of households and businesses. This context, financial inclusion has emerged as a major priority and is believed to enhance efficiency, stability, and policy effectiveness, contributing to economic growth, poverty reduction, and lower inequality. This agenda is central to ASEAN Economic Community 2025 visions, but significant gaps remain, especially in developing ASEAN countries. Existing literature has explored the positive role of inclusion, often focusing on single country studies. For example, studies in India and Bangladesh highlight inclusion pathway to improve bank performance and economic empowerment. However, many of these are single country in scope and fail to offer comparative insight across diverse economies. Moreover, prior research tends to overemphasize the supply side indicator like branch density, while neglecting demand side usage such as digital credit or financial activity levels. This study fills that gap by applying a two-stage analytical approach across 6 ASEAN countries, offering a broader regional perspective and a more balanced view of both access and usage. From this context, several research gaps emerge. First, most existing studies are country-specific. Despite the emphasis on inclusion in regional policy, its true impact on bank efficiency remains unclear. There's also no study examining how inclusion affects efficiency across different income levels within ASEAN. Crucially, prior work often overlooks both the supply side and demand side of inclusions. And finally, many studies use efficiency metric without linking them to specific inclusions indicator. From this, it creates strong needs to combine DEA for efficiency measurements and OOS regressions to analyze it. This study uses panel data from 200 banks across 6 ASEAN countries: Singapore, Malaysia, Thailand, Vietnam, Indonesia, and the Philippines, spanning the year 2013 to 2021. This sample covers over 75% of the total bank assets in the regions. The data we use is applying Fish Connect for bank-specific factors, World Development Indicator for macroeconomic variables, and last one is Financial Assess Survey for financial inclusions indicator. I applied the intermediate approach in stage one, which is the DEA model from Stevie and Lilly 1977, where the inputs and the outputs to compute efficiency score for each bank year observations. For stage two, we use OLS regressions against the financial inclusions indicator and specific controls and the macroeconomic variables. So to ensure robustness, I applied the two-stage DEAOS method proposed by and Nitrogen 2008. This is the key findings. Let me now walk you through the main findings. A negative impact on efficiency, branch density per 100,000 adults and per 1,000 kilometers per square, and high deposit levels are negatively related to efficiency. It suggests that too many branches increase operational costs and risk non-performing loans. The deposit, if not channeled into productive lending, it can lead to the liquidity hoarding and inefficiencies. For ATM per kilometer also show a negative effect, while ATMs per adults are positive. This reflects the idea that while ATM access is useful, access deployment creates redundancy and high maintenance costs. Similarly, a higher number of banks account correlates negatively with efficiency. More accounts do not necessarily mean more financial activity. Many may be dormant, creating costs without productivity. Positive impact on efficiency in terms of the credit card use, debit card use, and the outstanding loan volumes show positive association with efficiency. These findings emphasize the importance of digital finance, credit access, and scalable banking services in improving performance and cost effectiveness. Next, we proceed with the conclusion and implications. To summarize it, financial inclusion does not always enhance the bank efficiency. In fact, it may reduce efficiency when it leads to costly expansions, redundant infrastructure, or ineffective outreach. So the key takeaway here is optimizations matter more than expansions. The finding call for a digital transitions where banks prioritize digital credit tools, e-payments, and scalable lending platforms. And at the same time, strict KYC rules remain a barrier for many excluded populations. There is a urgent need for simplified digital identified solutions that balance the security risk accessibility. Detail of the policy recommendations. Looking ahead, we must continue to explore the fintech innovations. We need to expand mobile banking and digital ID solutions and refine the inclusion strategies to ensure they also support the enrollment. The ultimate goal is not just more access, but smarter, more efficient access aligned with financial stability and inclusive growth. So that's all from me. Thank you.